Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I just want to say a happy new year to everyone. I hope everyone is staying safe, especially for investors that are currently watching the news. I will make a comment for just a couple of minutes as far as what's currently going on in the markets before we dive into the education here today. But we're starting off 2021 in part 3 of our Learn to Trade Options course. This is a course designed for those of you that are relatively new to options trading to make sure that you understand the fundamentals of how to utilize options, the basics of option contracts, understanding the core concepts at a fundamental level so that you can progress as an options trader to more advanced trading and start trading them in your trading account if you have not already started trading options. So we've already finished course part 1 and part 2 of this Learn to Trade course. So if you haven't seen those recordings yet, or if you didn't attend those, we will show you here at the end as to how to access those recordings. For those of you that are brand new, you want to take the course in sequence so that you get the information that's sufficient, that's rolled into the next one before you go with each options education. So looking forward to talking about today's topic, which is actually the reason that many of us look at options to begin with. Whether you've heard from a friend or family or have heard from some other investor that told you about perhaps a story of someone who turned a small investment into a huge win using a call option or a put option. This is the leverage factor that a lot of investors are looking for when they're utilizing options. How can you turn a $500 trade into a $5,000 in return on your portfolio? Those opportunities only come from options. Now, many times investors think of leverage as this double-edged sword, and it absolutely is. Leverage is something that can be extremely powerful in your favor if you get the directional view right, but it can be devastating for your account if you get the directional view wrong. So what we want to talk about here today is how do options provide you with leverage, but do so in a way with limited risk so that you can define the amount of risk that you're taking, but still have leverage in your portfolio. So those are the things, like I said, that's partially what brings a lot of investors to view options to begin with. That's what gets you excited. So today I'm really excited to talk about this specific topic because I think it's one that many of you that are relatively new are looking to learn as to how can you leverage this leverage in your portfolio for your trading. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So like I said, over the past few weeks, we covered the introduction to options trading. This is the basic first step in just understanding how can options be utilized in your portfolio, and we covered the concepts of a call and put contract. Then we talked about how to generate income in your portfolio using options. So not as sexy, but it's really the core of what many investors utilize options for, which is generating additional yield for your portfolio. And today what we're here to talk about is, I think for many investors, what they believe is the sexier side of options. How can you leverage your capital using options? And then 2 weeks from today, we're going to be talking about entering your option orders and managing your positions with first trade. So the last one, next 2 weeks from today on January 20th, that's really going to wrap up everything that you've learned in the first 3 courses so that you can take what you've learned and actually apply them to an actual trading account here at First Trade. So really the beginner Learn to Trade course is designed to help those of you that are relatively new, who in the process of learning or trying to get started, to get you to understand how to place your first trade. So before I jump any further, I just want to quick poll here of the audience. How many of you are currently in the learning stages of options? Please type 1 into the chat window if you are in the learning stages of options, and please type 2 into the chat window if you've already traded some options if you already have traded options in your portfolio. Okay, so I see a lot of 1s, but I also see plenty of 2s. It seems like it's a almost an even split here between those of you that are relatively new to options and those of you that have experience trading options. So for those of you that are brand new, this is really designed to give you a very good view into the mechanics of how options apply leverage for your portfolio, but do so in a way with limited risk, and really helping you understand when you want to use it. Because a lot of investors have this idea that if you're bullish on a stock, buy a call option. If you're bearish on a stock, buy a put option. But that's not true at all. There's only certain scenarios of which you should buy a call option or a put option. We want to discuss when those are, and then also teach you a more advanced strategy, actually take it one step further and show you how you can improve your odds of probability, improve your risk to reward ratio, and actually lower your risk using a more advanced strategy. So those are the things we're going to discuss here today. And for those of you that have traded options, hopefully, and I'm pretty sure most of you, even if you have traded options, you're going to learn something new. Not only are you going to learn something new, you're going to learn something a little bit more as to when you should deploy these strategies. Maybe you understand the strategies already, but understanding when you should use them is extremely important. So those are the things we're going to go over here today. So we'll start off by talking a little bit about the difference between trading stocks versus options. It's really important to make that distinction, because when you're investing in a stock, you're effectively taking a bullish or bearish view on that stock. But when you're trading options, it's not as crystal clear as just being bullish or bearish. So I want to talk about the differences so that you guys can have a better understanding. Then we'll talk about the basic strategies, buying a call or a put option. These are the two strategies that are typically labeled as bullish and bearish, but in my opinion, as a strategist, I don't think that's an accurate description. I want to make sure you have the correct description of what a call and put options are. Then we want to talk about what are the challenges with buying a call or a put and how to overcome some of those challenges by trading a more advanced strategy called the debit vertical spread. And then what I'll do is I'll go through a few examples. I think that'll help investors solidify the concept of buying a call and then taking a more advanced approach using a debit vertical spread, using a real example. That's going to help you solidify. And then we'll talk a little bit about how to manage these types of spreads, how to manage buying a call or a put once you've purchased those, and then try to go through, again, as many examples as possible. And at the very end, we'll open this up for Q&A so that you guys can ask some questions. But the primary question that I want to help investors answer today is, how can options provide you with leverage, but do so in a way with limited risk at the same time? Because we think of leverage as a double-edged sword. It can work in your favor really well if you get the direction right, but could really devastate your portfolio if you get the direction wrong. So how can you have both sides? How can you have limited risk if you're wrong, but leverage if you're right? And that's exactly what options provides you with. And that's what, again, why I think a lot of investors are attracted to learning about options, because who doesn't want to be limited in their losses when they're wrong, but take leverage their capital when they're right. So my name is Tony Zhang. I'm the chief strategist at Options Play. Options Play is a tool that's available to you, integrated into your first trade platform, that's completely free of charge to all first trade investors. So today what I'm going to do is I'm going to show you some slides to teach you the concept and theories, and then I'm going to show you the Options Play tool, which you guys have access to, that you can use to select real symbols and deploy and implement the things I'm going to teach you here today. So for those of you that are still in the learning stages, when you're, a lot of investors ask us for ideas. You can follow me on CNBC every single Friday. I'm on a show called Options Action. It is the only show on CNBC that's focused just on options every single week. It's on Fridays at 5:30 p.m. On that show, what we do is we take different ideas that we have in the markets. We show you why we are bullish or bearish on a specific stock or ETF or market. And then more importantly, we show you how we utilize options to play those specific views. So if you're in the market of trying to learn more about options, this is a great way, a free way for you to participate and learn more about how to utilize option strategies for your portfolio. So let's start off by talking a little bit about stock trading. Now, before I jump in, I just want to do a quick comment because a lot of investors have been asking me over the past couple of hours what's currently going on with the markets. You know, we're seeing some chaos here in DC. We have seen protesters storm the Capitol building. Now, largely, you know, what's interesting about the equity markets is I think the equity markets are doing exactly what it needs to be doing, which is not panicking right now. We have not seen any knee-jerk reactions so far from the equity markets, and that's important for me to see. Market did sell off a little bit. SPY was near all-time highs at around 378 or so. Pull back here to about 374. We saw all the major indices pull back a little. The VIX also was elevated here up to that 27 level, but also pulled back here into the 25 level here. So markets so far, cooler head so far is prevailing at the moment, and that's what I like to see. Hopefully this is something that gets resolved relatively peacefully without having to extend into the overnight. If that does happen, I do anticipate perhaps a little bit more selling off from equities, but so far from the market's perspective, cooler heads have prevailed, and I think we can continue to invest with fairly normal conditions tomorrow, hopefully. So I just wanted to address that before we jump into the education. So let's start off by talking a little bit about stock trading. Now, how many of you here currently invest in stocks? If you currently invest in stocks or ETFs in your portfolio, please type 3 into the chat window. And if, let's say, you don't own any stocks or ETFs and you never traded stocks or ETFs, please type 4 into the chat window. So I'm pretty much seeing all 3s. Normally I see a couple of 4s, but okay, I see 1 so far. Sergio, who does not trade stocks or does not trade stocks or ETFs. So this webinar, generally speaking, is for those of you that have some stock investment, stock trading experience, because at the end of the day, when you're trading an option, you're trading the option on a stock. So in order to trade an option on a stock, you must have some experience trading stocks to begin with. So when we talk about stock investing, this is what I call a pure bullish or bearish exposure. What I mean by that is that when you buy a stock, the second the stock moves up, even by a penny, you start making money on that trade. And the second that the stock moves down by a penny, you start losing on that trade. That is what I consider a pure bullish or bearish exposure, right? And the easy thing about stock trading is that it's symmetrical exposure, meaning if you buy 100 shares of the stock and the stock goes up by $10, then you make $1,000 on the, if you buy 100 shares of the stock and the stock goes up by $10, you make $1,000. If the stock goes down by $10, you lose $1,000. It's symmetrical. You know exactly how much money you have at risk if the stock goes up by a certain amount, and you know exactly how much you'll gain if the stock goes up. You know exactly how much you gain if the stock goes up by a certain amount. You know exactly how much you lose if the stock goes down by a certain amount. And you can hold on to a stock for as long as you wish, presuming that you have enough margin, if you are trading on margin, to hold on to that stock. So there's no time horizon. The only limitation that you have with stocks is the fact that you have no neutral options, meaning if you believe that the stock is not going to go much higher or much lower, there's really not much you can do with the stock in order to profit from that view. So stock trading is very simple. It's relatively easy to understand. It's symmetrical, but there are some limitations in terms of you can only seek bullish or bearish exposure. And for many investors here, you don't seek any bearish exposure because perhaps you don't have margin accounts to short the stocks. Maybe you don't want to short the stock. Maybe the stock is hard to borrow. So largely you are restricted, if you will, to looking for stocks that you think are going to go up. So that many times may limit the universe of stocks that you want to trade, because you have to look for stocks that you think are going to go higher. Versus when you trade options, you have a lot of options. And this is really the first thing we want to explore. So the first one we're going to look at is buying a call option. Now, a call option is typically referred to by most investors as a bullish strategy. So we're going to go through an example here and show you why a call option is considered bullish and why I consider that an inaccurate statement for the strategy. So for this example, I'm going to use stock XYZ trading at $100. So I'm going to use $100 for the theory side so that everyone understands. Then we're going to jump to a real example to help to make this a little bit more clear. So stock XYZ is trading at $100 and I'm bullish on this stock. I think the stock is going higher. What can I do? So as a stock investor, I would buy the stock. As an options investor, I would buy an option. In this particular case, maybe I'll buy the $100 call option, which is the at the money strike price, the strike price that is the same as the current price of the stock. That is usually a good starting point when you're thinking about what strike price should you choose. And let's say this call option in this particular case cost me $4 to purchase this call option. Now, for those of you that attended the first session or the second session, you remember we talked a lot about, the mechanics of buying a call option or selling a call option and what it means. So we're going to do a quick review of that, because if let's say I buy this $100 call option and it costs me $4, what is the break-even point of my strategy? Meaning, how far does the stock need to move before my strategy is profitable at expiration? If anyone has the answer, please type it into the chat window, into the chat window. And let's say in this particular case, I'm bullish on the stock and I think the stock's going to go to 110. And Bryce had the right answer, and the answer is 104. Now, because you pay $4 for the call option, that's the amount that the strategy needs to overcome before you're profitable. So before, when I buy a stock, the second the stock goes higher, even by a penny, I start making money on that trade. But when you buy an option, because you effectively start $4 down, you have to overcome the $4 payment that you've paid to get into the option before you're profitable. So when I buy a call option on stock XYZ that I think is going to go higher, I can't just buy a call option because I think it's going to go higher. I have to buy a call option only if I think the stock is going to exceed the break-even price. In this particular case, the break-even price is 104, which is the $100 call option plus the $4 that I pay. My break-even is 104. And what that means is that it restricts me from buying a call option only if I believe the stock is going to be bullish by a certain amount. That, in my opinion, is the most accurate statement for a call option, because, again, the stock has to overcome the amount that I paid in order for me to be profitable. So if I'm bullish on stock XYZ and I think the stock's going to go to 110, well, that exceeds my bullish, the break-even price. And in this particular case, it might make sense for me to buy a call option. But in other scenarios, maybe the stock doesn't go up to 110. Maybe it only goes up to 102. What happens if the stock goes from 100 to 102 and I had bought this call option? If anyone has the answer, please type it into the chat window as well. So again, the stock did move in the direction that I expected to. It just didn't move as far. It went from 100 to 102 instead of 100 to 110. And the answer is, a couple of people had the right answer, but what I was looking for is that I would actually lose $2 because the option is worth $2 at expiration if the stock's at 102, but I paid $4 to get into it. So I'm down actually $2. So this is why it's difficult for many times for investors to understand how to utilize options, because the strategy itself is very interesting from the perspective of, if I get the directional view right, a call option will give me unlimited gains to the upside. So if the stock goes from 100 to 110 or 120 or 130, 140, it keeps going higher and higher and higher, I can make more and more money. But if I get it wrong, the most I can lose is the $4 that I pay. That's the asymmetrical risk payoff that we get when we're buying a call option. This is what's attractive for a lot of investors, because here you're controlling a $100 stock for just $4, meaning it only costs you 4% of the underlying stock price to control 100 shares of it. And if you get the directional view right, there's unlimited amounts of money that you can make to the upside. And if you're wrong, even if the stock goes to zero, the most you're going to lose is $4 a share. If you had bought if you had bought 100 shares of this stock and the stock went to zero, you would lose $10,000. Here, you would only lose $400 because each contract is for 100 shares. So that's the risk-reward ratio that a lot of investors are looking for when they're buying a call option. They want the unlimited gains to the upside with limited losses to the downside. Now, when you look at a payoff graph like this, a lot of investors say, why would I ever buy the stock? Why wouldn't I always buy the call option? Because I want the leverage if I'm right, and I don't want to be caught with huge losses if the stock plummets. And the answer to that question really comes down to what I said before. It comes down to the fact that even if you're bullish on a stock and you buy a call option, there's still the opportunity to lose money. And if anyone here has ever bought a call option, saw the stock that went higher, and then realized that you still lost money on the trade and felt a little disheartened or felt that you were cheated a little bit, please type 5 into the chat window. If you've ever bought a call option, the stock went higher, but you still lost money on that trade. Please type 5 into the chat window if you've been in that position. I see a lot of 5s here so far. And that's exactly the challenge with buying a call option. On the surface, it looks really attractive. Unlimited gains with limited losses to the downside. But the challenge with the fact is the fact that not every day are you going to believe that the stock is going to make a big move from 100 to 110. Maybe you think it's only going to go from 100 to 105. In that particular case, you're effectively risking $4 to try to make $1. That's not necessarily a very attractive risk to reward ratio. Not a lot of people want to risk $4 to make $1. So you really have to believe the stock's going to make a big move to the upside. Let's say you think it's going to go to 110, then it might make sense for you to buy that call option, because here you're risking $4 to potentially make $6 if the stock goes from 100 to 110. That is, roughly 150% return on your investment. Now, again, it's not every day that you find stocks that you think are going to go from 100 to 110 in a short amount of time. So that's the biggest challenge that you have when you buy a call option. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. If the risk to reward ratio makes sense to you and you understand that the challenge with buying a call option is that the stock needs to make a big move before the strategy is profitable, because you can get the direction right and still lose money because the stock didn't move far enough in order for you to be profitable. So again, remember, a call option is not a bullish strategy. It is bullish by a certain amount, and that certain amount is driven off of one thing: the cost of the call option. So if you have a call option that's relatively cheap, the stock does not need to move as much. If the call option is very expensive, then the stock needs to make an outsized move before you're profitable. So like I said, the risk to reward ratio is what attracts most investors to the call option, the fact that you can have limited losses with gains to the upside. But the challenge, again, is the fact that you need a big move before the strategy is profitable. So what I'm going to do is I'm going to teach you a trick. I'm going to teach you a more advanced strategy that can help you overcome some of this, okay? And it's actually going to reduce your risk even further. So same example, stock XYZ trading at $100. I think the stock is going to go higher. I think it's going to go to 110. So what I'm going to do here, I'm going to teach you what advanced options traders or strategists will do is I will still buy the same $100 call option. I will pay the same $4 as everyone else. But remember, I'm bullish on stock XYZ, and a call option has an expiration date. So the stock needs to make the move from 100 to 110 by my expiration date. It's not like a stock that I can hold on to for as long as possible or as long as I want. It has to make the move before the expiration date. So the reality of it is the fact that even though you're paying for unlimited upside, and technically you are participating on upside, unlimited upside, if the stock jumps from 100 to 200, maybe on some really good news or some earnings event, the stock makes a big jump and you participate on that, but that doesn't happen very often. And it's quite rare for that to happen. So what you realize is that when you pay the $4 for the $100 call option, what you're paying for is unlimited upside that you may not even believe is actually going to materialize. So the power of options comes into the fact that there are a lot of different options that you can trade. You can buy a call option because you think you're bullish on the stock, but you could also sell a call option if you're bearish on the stock or neutral on the stock. And this is where the creativity part of options really comes into play. So yes, I'm going to buy a call option, a $100 call option. I'm going to pay the $4 like I did before. I'm buying unlimited upside. But in this particular case, let's say this option expires 2 months from today. And I say to myself, Well, there's no chance XYZ is going to be at 200 by next month or 300 or however high that I think the stock's going to go. I only think it's going to go to 110. So why should I pay for all that upside? And the answer is you don't have to. You can actually sell off some of that upside. So what I'm going to do is I'm going to sell, let's say in this particular case, a 110 call option and collect $1 for it. Before I paid $4 for the call option. Now I'm going to collect $1 by selling off any gains above 110. So I'm basically saying I don't think it's going to go above 110. And if someone wants to buy that from me, they can buy it from me for $1. And what that does is it allows me to participate in the upside, similar risk profile as I have with the call option. But now my risk is actually reduced from $4 a share to $3 a share. So before I was controlling 100 shares of this stock for $400, which is 4% of the underlying stock. Now I'm controlling the same 100 shares for just $300 or 3% of the stock. So this is what I'm doing. Number one is I'm reducing risk. And as an options investor, as an option strategist, my number one goal with utilizing options is always to reduce risk. When I'm able to reduce risk, that in itself is going to amplify my returns. And I'm going to show you how. Just by reducing risk alone, I can amplify my returns. So here, what I'm doing, number one, is I'm controlling the same position that I was doing before for less capital. So I'm actually increasing my leverage. Now my max risk is reduced from $4 a share to $3 a share. I've reduced my overall risk. And the only thing that I'm giving up effectively is if the stock makes a big move to the upside, I don't participate in any gains above 110. But if, let's say, I think the stock's going to go from 100 to 110, before I was risking $4 to make $6, which was, as we said before, 150% return, which is by no means a small amount to make on a 10% move on the underlying stock. If you had bought the stock, you're looking at a 10% return. If you bought the call option, you're looking at 150% return. This is the leverage factor a lot of you are seeking when you're trying to trade options. Now, here, what I'm doing is I'm only risking $3, but if the stock goes from 100 to 110, how much profit do I make on this trade? If anyone has the answer, please type it into the chat window. If I'm risking $300 on this debit spread, if the stock goes from 100 to 110, how much profit do I make? And Oscar has the correct answer, and that's $7. So here, for the same movement from 100 to 110, instead of risking $4 to make $6, which is 150% return, now I'm risking $3 to make $7, and that translates to a 233% return. So same trade, all I've done is I've sold off the gains above 110 because I don't think the stock's going to go to 110. And even if it does go above 110, guess what? I'll be happy with the 233% return if the stock makes a 10% move to the upside. And what I'll do is I'll trade that off for a little less risk. So even if I'm wrong, I only risk 3% of the underlying stock price. And if I'm right, I make a 233% return on the underlying position that I have. So that is the trade-off that you're making here when you're buying a call option versus a debit spread. But this is really why I encourage investors, even in the very early days, to explore these more advanced strategies, just so you understand that they exist, even if you're not ready to trade them yet, even if you don't fully understand them. This, in my opinion, is a very good way to gain a little exposure to what the power of options actually are, so that you could better understand whether or not it's a strategy that you want to deploy for your portfolio. Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you. Okay, perfect. So before I jump into any further, what I do want to do is I want to go through a real example, because again, I think that the best way to learn, I always think, is looking at real examples. When you look at real examples, that's when things kind of click for a lot of investors, especially when we look at stocks that many of you are familiar with. So we're going to look at Apple here. Apple closed at 126. Apple's had a pretty nice run here from 113 to 140 or so, pulled back here roughly, a third of that. So maybe you think Apple's ready to continue moving higher here. So let's take a look at some options. Now, the first trade, the options play platform is embedded into your first trade account. It's free of charge for all investors who have an options approval for first trade. And when you launch the tool itself, it's divided into 3 sections. You have trade ideas and watch lists on the left. You have your security analysis panel here in the middle, and you have trading and income here on the right-hand side. Now, we're going to focus our attention here on the trading tab here. So for any symbol that you type in, you can either select I'm bullish and see 3 bullish strategies on the right-hand side, or you can select I'm bearish and see 3 bearish strategies on the left-hand side. In this particular case, we're going to look at bullish strategies because that's what we just referred to. And when you select I'm bullish, we'll always show you 3 strategies. Buying 100 shares of the stock, this is what the strategy that most of you are familiar with. We're also going to show you buying a call option, which is the first option strategy I showed you. Note here that not only do we select the strategy for you, we also select the expiration date and strike price based on best practices for starting your investment research on. And lastly, on the right-hand side, we have that debit spread, that vertical spread, where not only do we choose, again, the strategy for you, we pick the expiration date and we pick the strike price for you. We pick the strike prices based on, again, probability-based approach, using best practices, using back-tested results as to what are the optimal starting points for each one of these strategies. You can modify them if you want, but they're pretty good starting points for you to start your research. So Apple's trading at 126 and 2/3 right now. Let's say you think Apple is going to resume back to its 138 high here. So what we're going to do is we're going to use our P&L simulator to compare these 3 strategies. So buying 100 shares of the stock would cost you $12,000. Buying a call option will cost you $965, a small fraction of the 12 grand that you need to buy 100 shares of the stock. And as you can see, this vertical spread here on the right only costs you $744. Just to do a little quick mental math here, $965 out of $12,715 represents, the call option would cost you about 7.5% of the stock price to buy this call option. So that's for the call option. Now let's just take a look to buy the vertical spread, $744 out of $12,715. Now you're only risking 5.8%. So again, these strategies, a lot of investors think of leverage or options as this risky strategy. But in reality, what we're doing here is we're teaching you how to actually reduce risk. Because if you bought 100 shares of Apple, you're exposing yourself to $12,000 worth of risk. Now, granted, the chances of Apple going to zero are relatively slim. But when you're buying a call option or a call spread, no matter what happens, even if the stock goes to zero, you can only lose either $965 for the call option or $744 for the debit spread. Does that make sense, everyone? Please type 9 into the chat window if that makes sense to you. And this platform is designed to make this as easy as possible for you. You type in any symbol, click on I'm bullish, and we're going to show you these 3 strategies. You don't have to do anything else. And then what you can use is the P&L simulator. This is probably one of the most powerful tools on our platform. What this allows you to do is say, what happens if I think the stock's going to go from 126 to 138? If I think it's going to revisit the all-time high, if I bought the call of the stock, I'm looking at about an 8.5% return. If I bought the call option, a 34% return. So that is the leverage factor that I'm getting. Not a huge leverage, but a little bit of leverage here. And as you can see, if I go even further, if I look at the vertical spread here, because I've reduced my risk here from $965 to $744, for roughly, a little bit more profit here, I'm making $556 profit versus $335, so about an extra $200 in profit. It roughly translates into double the return because I'm reducing my risk by about $200 and so or so, but I'm also increasing my profits by $200 or so. And what that has the net effect of doing is doubling my returns. And that's why we seek strategies like here, this one on the right, many times when we trade this in our own accounts as option strategists, is we use these vertical spreads to maximize our returns by minimizing our risk. And you can type in any symbol. Let's say you're bullish on, I don't know, Spotify. And I'm just pulling random symbols here. These are not symbols that I'm necessarily suggesting that you should buy. But maybe you think Spotify, streaming is going to do well in the future. So you're looking at, instead of buying $31,000 worth of stock, maybe that's a little too expensive for you. Buying a call option only costs $2,600, or buying that call spread only costs $1,870. And what you can do is you can put in different scenarios. Let's say you think Spotify is getting getting back to its all-time highs of 345. Look at what your expected return is. But I also always encourage investors, first, before you look at your potential return, look at how much risk you're taking. I think a lot of investors don't spend enough time understanding what their risk is, and that is one of the reasons that we created the P&L simulator, so that you can say, well, I think Spotify is going to go higher. But what if I'm wrong and the stock plummets back down to 250 or 246, which is where it was in mid-November? So 240, what did I say, 245? If the stock plummets to 245, if you had bought 100 shares of that stock, you were looking at a roughly $7,000 loss on the stock position. If you bought the call, you're looking at a $2,600 loss. If you're looking at the spread, you're looking at an $1,800 loss. So, just from the risk perspective, right off the bat, number one, you should understand what your risks are and ask yourself, number two, am I okay if I took an $1,800 loss on this particular trade? So if you have a $5,000 portfolio, I would tell you that's way too much risk. This is a trade that you should stay away from. If you have a $100,000 portfolio, then maybe this is more appropriate for you, because on a $100,000 portfolio, if you lost $1,800, you still have 98% of your account intact to place another trade. But if you only had a $5,000 portfolio and you're wiping out two-thirds, a third of it, or close to 40% of it on a single trade, I would tell you do not place that trade. So it's very, very important for investors to understand what your risks are. And if you are comfortable with those risks, then ask yourself, if the trade does go in my favor, am I happy with that type of return? If you are, then that's a trade that you might want to make. And one of the great things that we've built into the integration to First Trade is that you can click on the trade button, and you can actually, first of all, there's a strategy checklist that allows you to check a few things that are important for options investors to understand with your risks that you're taking, like earnings dates, things like that. And then if you're ready to place that trade, you can click on the preview order button, and we will actually pre-fill your order ticket on First Trade for you. This is designed so that you don't make any mistakes on your order entry, that you get exactly what you're looking at here on the Options Play platform, and then you can just hit preview and send this off for execution. So this platform is really designed from the ground up, and you can see this options wizard. That's how you can access it. You can also access it from your options chain. There's an options wizard button here as well. When you click on that, it'll launch the Options Play tool. That is a tool that is designed to help you improve the ways that you explore, analyze, and understand your option strategies. So with that, what I'm going to do is I'm going to go back to our slide deck. I'm going to look at some bear strategies. Now, I don't think I need to necessarily go through this in the same amount of detail because it's the exact same thing, but for bear strategies, it's effectively a mirror image of what we were talking about before. So if stock XYZ now I think is going to go lower, let's say I think the stock is going to go down to 90. Now, as a stock investor, there's probably not much that you can do if you have a $100 stock that you think is going to go down to 90. Many of you are not going to short stocks. Maybe you don't want to borrow the stock. Maybe you don't want to take on unlimited risk. That's another reason why I don't think it's a good idea to short a stock, is because you truly have unlimited risk. Instead, you should look at buying a put option. So here I'm looking at buying a $100 put option, paying, in this particular case, again, $4 for that put option. Now, when you buy a put option, what you get is unlimited downside all the way down to zero. So if the stock keeps going lower and lower and lower, you're going to make more and more money from your put option. So if you get the directional view of the stock correct, and the stock keeps going lower and lower and lower, you're going to make more and more money from your put option. But on the flip side, if you're wrong and the stock shoots up to 150 bucks, the most you will lose is the $4 that you pay for that put option. That's the asymmetrical risk. That's the leverage that we're all looking for with limited risk. Now, just like a call option, the challenges are the same. What I pay for that call option, that's the most I can risk, but that's also the amount that I have to overcome before the strategy is profitable. So if I think the stock's going to go lower, but the stock only goes down to, let's say, 97 bucks, guess what? Even though the stock went in the direction that I expected to, I've lost money on the trade. And that, again, is one of the most disheartening things, I think, for beginners to learn. And some investors, unfortunately, learn this by trial and error. They don't go through the proper education. They just say, okay, I learned that a put option is bearish, so they buy a put option on a stock they think is going to go lower. Next thing they know, the stock did move lower, but they still lost money, and they're not sure why. And this is due to the fact that you have to overcome the payment that you pay for that put option. But it does give you unlimited downside, so as long as the stock keeps going down, lower and lower, you make more and more money. But again, the challenge here is the fact that you have to overcome that payment that you pay for that put option before you're profitable. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. So now just taking that one step further, again, just like the one before, right? Just because I'm bearish on a stock doesn't mean that I think the stock's going to zero. Certainly maybe not by the time that the option expires, right? So I could be bearish on the markets because I think, things are getting a little crazy out there. Valuations are getting a little crazy. But I certainly don't think the markets are going to zero. I just think they're going to go down maybe 5% or 10% over the next month. So how can you utilize options to play that? Because at the end of the day, when you buy a put option, what you're effectively expressing is the fact that, or what you're paying for rather, is the fact that you believe that the stock could, in theory, go to zero. But why should you pay for all that upside if you don't think it's actually going to happen? Well, the flexibility of options allows you to sell some of that off and sell off any downside below 90 by selling a put option. So you buy a put option that you think is going to go down, and then you can sell a put option that you think the stock's going to stay above that specific price. So in this particular case, I'm buying the $100 put option, and then I'm going to sell a $90 put option and collect $1 for it. And because the $1 I collect will offset the $4 that I pay, my net effect on my trade is the fact that I'm only now risking $3 a share as opposed to $4 a share. And what that means is that the stock, instead of having to move $4 lower for it to break even, now the stock only has to move $3 lower before it breaks even. So what I've done is I've improved my probabilities of success on the trade because the stock doesn't have to move as far before I'm profitable. I'm risking less on the trade. Before I was risking $4, here I'm now only risking $3. And I've increased my leverage. So if I am right, I get higher returns. And that is, again, is the power of these debit spreads. And what you start to learn, and this is just the very beginning of learning how to be creative with options to get the exact payoff graph that you're looking for. Now, sometimes maybe you think the stock's going to go down to 85. So instead of selling the $90 put, you might sell the 85 put. Maybe you think that's only going down to 95. So instead of selling the 90 put, you might sell the 95 put. These are adjustments that you'll start to learn as you learn more about it. But the key here is to learn the concept and show you how the tools, how you can access the tools to allow you to start exploring and start experimenting with this. And that, again, is all available to you free of charge here at First Trade. Does that make sense, everyone? Please type 2 into the chat window if those put options make sense to you. And I'll just do a very, very quick review of, let's say, what is a bearish stock? There's not a lot of bearish stocks here in the market right now, but maybe Intel. Maybe you're a little bearish on Intel. You think this chip maker is really struggling here. Hedge funds have stepped in and said, and have asked them to, move off of their own production for the 7 nanometer chips. Maybe you're bearish on Intel. So, and the trends here are actually turning bullish here, but it is very weak here from a technical perspective. So maybe this is one that you want to be a little bit more counter, or maybe a little bit more counter to. So shorting the stock, buying a put option, buying a put spread here. Again, the platform selects everything for you, the strategy, the expiration date, the strike price as starting points. You can always modify it if you want. You can change the expiration date. You can change the strike price. We have both. You can move it by just clicking the click of a mouse, moving the strikes down one or up one, or you can use the drop-down menu. Either one, but you can modify this, and you can use the P&L simulator. So Intel's at 51. Maybe you think the stock's going to go back down to 45 near this range, at the bottom of the range. And you can see if you shorted the stock, you're looking at about a 12% return, which is not bad for shorting the stock over what is effectively 2 months' time between now and March 19th. If you bought a put option, you're looking at a 70% return, and you're only risking $440. When you short a stock, you have unlimited risk. That's why I never, ever recommend investors to short a stock. You're much better off, in my opinion, buying that put option and protecting yourself so that if for some reason Intel stock shoots up higher, you only risk $440. Or you trade this vertical spread here, which only risks $369. So if you do get the move that you expected to, notice how the returns get amplified from a 70% return to a 103% return, risking the least amount of capital and giving you the best leverage on your capital as well. So, when we talk about leverage, what we're really doing is reducing risk as much as possible. We're reducing the capital outlay that you need to get into the trade. The further you're able to reduce the capital outlay that you need to make the trade, the higher your returns are on that trade when you do get it right. And that's really the power of options. And that's really the power of the strategies that I'm showing you here today. But again, feel free to experiment. Change the strike prices. Maybe you don't think the stock's going to go down to 42. You only think it's going to go down to 45. Make changes. See how they affect the strategy and go through the scenario here. Now, as you can see, if the stock goes down to 45, before I was looking at 103% return. Here I'm looking at 129% return. I've optimized it based on how far I think the stock's going to go. So this is really just a tool that allows you to take what you've learned here today and start experimenting, start exploring, and once you're ready to start trading them, hit that trade button, preview order, and we will pre-fill that ticket here on your first trade account for use for execution. So before we wrap this up for Q&A, I just want to talk a little bit about the strategy itself. A lot of investors ask us, how do you select these strategies? So the platform automates it for you, but I do want to just walk investors through who want to learn. Generally speaking, when you're buying a call option or a put option or a debit spread, you generally want to go out about 60 days from expiration as your starting point. And whenever you're buying a call option, you always want to buy what we call the 50 delta call or put, which is the at-the-money call or put. Now, and what you want to do is you want to sell the 20 delta call or put against it. So if you're just buying it, then you just buy the at-the-money call or put, the 50 deltas. If you are trading in the debit spread, what you want to sell is roughly a 20 delta call or put against it. And when you use this type of strategy, the call option that you purchase, or I'm sorry, the call option that you sell, the option that you sell will always offset roughly 20% of the cost of the option that you're paying. And it's really important to understand the characteristic of this type of strategy, because all option strategies are a trade-off between risk to reward and probability. And unfortunately, I see too many investors focus on just one thing. They focus on just probability, because in their mind, they think that if I have a high probability of success, then I'm going to win more often, and I'm going to be more profitable. But what they forget to understand is that when you have strategies that have high probability, that means that you have very poor risk to reward. These two are always going to be at opposing forces to each other. You're never going to be able to find a strategy that's high probability and really good risk reward. It just doesn't exist. You either have very high probability and low risk reward, or you have low probability and very high risk reward. Now, it's important to understand that when you buy a call option or buy a debit spread, these are lower probability characteristic trades. You're going to win less often. But when you do win, your risk to reward is substantially higher. Actually, this is incorrect. It's actually $100 worth of risk for potentially somewhere in the $200 to $300 potential reward. So what you're doing is you're risking less to make more, but you're doing so in a way, whenever you risk less to make more, you're obviously going to win less often. So it's just important that you understand the characteristic of these types of trades, and also understand that no matter what option strategy you choose, if you only look at one half of the equation, you are likely missing a big piece of the picture. You always have to look at both sides, what the probability is and what the risk to reward is. And you want to try to find a bit of a balance here. You never want to be too far, meaning too high probability or too high risk to reward. You usually, are going to find some inefficiencies in markets with that. And I just want to cover quickly what delta means. Delta just means the probability of the call or put option being in the money at expiration. And how do you know what delta you're buying or selling? It's actually on the Options Play platform. I'll show you where to access it. But it's really a tool that's, when you're selecting your strike prices here, you'll see on the strike drop-down menu, you'll see the strike price. you'll see the premium, meaning how much is that call or put currently costing, and what the delta of that option is. Looks like my internet here is a little slow here today. Here we go. So when you click on modify and you select a strike price, you'll see there's the stock price, the strike price, the price of the option. So in this particular case, the $50 call option on Intel costs you $3.95, and it currently has a 59 delta. So the delta, you want to get somewhere close to 50, meaning this is the probability of the stock being in the money by expiration. So what is the probability of Intel being above $50 by expiration? It's actually 59%. That's how we calculate delta. And we always want to sell roughly the 20 delta. And that's why in this particular case, we're selling the 57.5 here, which is a 26 delta. What we're doing here is we're trying to optimize the probabilities, the probability of making money on the trade and at the same time selling a strike price that's far enough out of the money that has relatively low probability of success. And what I'll do is I'll wrap this up with this one last piece, which is how do you manage one of these trades once you're in them? So let's say you buy this debit spread for $280, or you buy this call option for $395. Once you're in that call option or in that debit spread, how do you manage it? This is the part where the trade management is actually pretty simple, and the rules for it are pretty straightforward and easy to remember, in my opinion. It's always good to have mechanical rules, because when you have mechanical rules as to when to get in and when to get out, you tend to be less emotional, you tend to make less decisions based on emotions, which is never a good thing to do when it comes to trading. So once you enter one of these trades, there are effectively two criteria that could cause you to potentially exit this trade. There is a take profit and there's a stop loss. And these are based on rules that most investors can remember. Number one, you want to cut your losses when you've lost 50% of the premium that you have paid. So let's say you pay $3 or $300 for a call option or a debit spread. What you generally want to do is you want to cut your losses when something that you paid $3 for is now trading at $1.50. So you've lost 50% of what you paid. It's time to cut your losses, move on to the next trade. Now, if on the same trade you buy a call option or a call spread for $3 and it increases in value to $5.25 to $6, that is a 75 to 100% gain on the premium that you paid, then it's time to start taking profits on that trade. So those are the mechanical rules that you can apply to once you're in one of these trades to help you decide, should I hang on to it? Should I close it? Should I cut my losses? Or should I take profits? These mechanical rules help remove the decision-making process. I know many of us have sat in front of a screen, seeing all the numbers tick by, trying to figure out, should I get in? Should I get out? Not knowing what the answer is. When you have these mechanical rules, it makes it clean cut and black and white, makes it really easy for you to focus on what's important and not have your emotions drive your investment decisions, which generally speaking is not a smart idea. So with that covers what I wanted to share with you here today. I just want to remind everyone who is an options investor here at First Trade to look at your First Trade iOS and Android platform. There are some fantastic features on the iOS mobile platform that First Trade has developed over the past year to enhance your options trading experience. Everything from easy to enter complex option orders off of the option chain, the risk and reward profile that you can actually see off of the option chain, the ability to close complex options positions, so closing one of these debit spreads with a single click of the mouse, and now you can actually edit a complex order without having to cancel and place a brand new one. You can effectively cancel and replace in a single order. So I really recommend for investors to check out the iOS and Android platform. And one other thing, for those of you that are looking for ideas, and I know everyone here on this call is looking for ideas, every single Tuesday morning, I host an event here at First Trade at 8:30 a.m. before the market opens on a market overview. This is where we talk about the broader markets. We talk about macro indices. We look at where domestic equities are, where international equities are, fixed income, commodities, rates, all of these. We look at all of these different markets to give you an idea as far as how I'm viewing the markets. It's a glimpse into a more in-depth version of what you catch on CNBCs, where you have a full half an hour of me explaining to you my charts and how I'm currently looking at the markets and showing you a few of my ideas and how I would play them using the market. So you can sign up for that Tuesday morning event using the link here on your screen, and I'll post that link into the chat window. And also, I also publish a newsletter every single Friday. This is where we send out a bullish idea, a bearish idea, and we produce a cover call and short put report. You can sign up for that using the second link that I will post into the chat window here. So overall, you have a lot of resources available to you here at First Trade that helps you learn, explore, and see the different options that you have to help you support you in your investment decision-making process. Everything from idea generation to seeing how I set up trades in my portfolio using the options newsletter, the Tuesday morning outlook sessions, the options education sessions that we're doing here, access to the options play platform. You really have a wealth of information available to you as a First Trade customer. So I really hope that today I was able to give you a glimpse into all the different things that you have access to so that you have a better understanding as to how to utilize it for your portfolio. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, at the bottom, there's a chat window and there's a Q&A window. If you don't mind, please bring up the Q&A window and post your questions into the Q&A window, and I will try to answer as many questions as I have time for here before I sign off. So Ag is asking, does the options value decay to 0 at expiration? So Ag, the option will decay to the intrinsic value of the option at expiration. So an option premium prior to expiration is always made up of two parts, the intrinsic value and the extrinsic value. The extrinsic value is what we refer to as time value. The time value portion of it is what it will erode to 0, but you will always be left with intrinsic value. Now, sometimes if an option is out of the money, the intrinsic value also is 0, but if an option is in the money, then it has intrinsic value, and that will not erode. Only the extrinsic value of the option will erode at expiration. So great question. Julia is asking, hi, if I own stock and I sell on this stock cover call options, when I collect the premium, when it shows up in my account, immediately or when I collect the premium, immediately or when buyer exercise option or on expiration date? So I think the question from Julia is, when you sell a cover call, do you collect the premium immediately, or do you only effectively collect the premium, at expiration or when the option is assigned to you? And Julia, the answer is that the premium is actually collected in your account as soon as you sell that cover call. Now, that's different than profit, meaning you only capture the profit at expiration if the call option expires worthless or if the call option is exercised. So you do collect the premium up front, but you're not profitable per se until expiration. So I hope that perhaps clarifies that. Well, and to the second part of Julia's question is, if she sells a cover call and the buyer decides to exercise that option, should I sell my stocks? Well, if the buyer has exercised the option, that means that the stock is automatically taken out of your account. There's nothing you need to do. The stock is just automatically taken out of your account. So you don't have to go out and sell that particular stock. If the stock hits the strike price before expiration and the buyer has not exercised, can I sell the stock at a higher price? Yes. If the option has not been exercised, which rarely they get exercised prior to expiration, you can always sell your stock at the higher price, but you have to buy back that call option because you can't have a naked call option out there. Because it's a cover call, you have to buy back the call, then sell your stock. Cassandra, I've been advised to only sell options. Why not leg into a put, selling both legs? Not sure if I'm wording the question properly. So Cassandra, selling a put option obligates you to buy the stock. That's a completely different strategy. And Cassandra, I hate blanket statements like that. You should only do X or only do Y. In the world of options, you have a lot of different options. And I hate to see investors be shoehorned into one specific strategy because they heard that from someone. I don't believe that you should only sell options or only buy options or only trade this strategy. There are so many different things that you can do. Explore and test around and try for yourself and decide for yourself what you want to do. Yes, there are some investors that only sell options. Predominantly, those are covered calls and cash secured puts. And there are many traders, even myself, that predominantly sell options, but that doesn't mean that's the only strategy that I trade. So I think that there's a difference between the two. John is saying, when you use two options to buy options, do you sell these two options at the same time? John, I'm not sure what you mean by when you use two legs to buy options. If you're talking about the debit spread and whether you're trading them at the same time, the answer is yes. So when you click on this trade button and we pre-filled the ticket for you, what you're effectively doing is you're trading both legs. You're buying the $50 call option. You're selling the 57.5 call option. You're trading them at the same time in a single order, and you're trading it for one net price. So it's two trades done at the same time. If that's your question, I hope that answered your question. Bob is saying, you covered plug yesterday and made 7% today. Great to hear, Bob. So that Bob is referring to a stock that I talked about yesterday morning on the Tuesday morning market outlook session. And this is one to pay attention to. Those are when I give some ideas. Bob obviously took one of the ideas that I sent out, was able to make a profit on that. Glad to hear that, Bob. Thank you for sharing. But if you want to learn more, please use the link here on your screen to sign up for that Tuesday morning session. It is in the chat window at the bottom of your screen. Cassandra, currently for the options play tool is not available on your phone. Only the options play tool is available on desktop. Christian is saying, hi, Tony. When do I have to use call debit spreads instead of put debit spreads? So Christian, call debit spreads are when you're bullish. Put debit spreads are when you're bearish on the stock. So pretty crystal clear. You're either bullish on the stock or you're bearish on the stock, and that's what determines which one you use. Hi, how do you close the spread with one order or two? Same thing, when you enter an option strategy with one order, you generally want to close it with one order as well. I don't know if I have any multi-leg positions here. Oh, I do, looks like. Yeah, so here, as you can see, you can close spread, or in this particular case, this is actually a butterfly. I'm not going to get into what a butterfly is, but it's actually a three-leg trade. But as you can see, I can click on close butterfly and actually select the three strike prices to close on my butterfly. This is really designed to help you easily fill out a butterfly to fill out. So as you can see, I can select my butterfly. It'll fill out all three legs, and I can preview order and send it off. So opening and closing transactions for these 2, 3, 4 leg trades, you should all generally open them in one order and close them in one order. Hopefully that answered your question. Hi, maybe this was covered in one of the previous sessions, but I missed them. The 50 delta, why is the question, why the 50 delta for buying? If you want as in the money as possible at expiration, wouldn't you want to go as close as 1 as possible? So I'm not sure where you heard that you want to be in the money as much as possible at expiration. Wouldn't you go close to 1? That's not true at all. And the reason that you don't want to go for a delta of 1 is because then you're just basically trading the stock. A delta of 1 is effectively the stock. The reason that you want a 50 delta is you want that convexity. If you the hockey stick comes from the fact that you're trading a 50 delta. It will increase the delta to 1 as you get more and more correct. It will decrease the delta to 0 as you get more and more wrong. That's how you get this hockey stick effect. If you have a delta of 1, then you're just looking at a stock, you're just looking at a payoff graph that looks like this. It's the same as a stock. You don't want to trade the stock. You want that convexity. You want that hockey stick. That's why we use the 50 delta. And for those of you that missed the first sessions, if you want to know how to access them, you can go to firsttrade.com optionsplay.com. I'll send the link to everyone under research and tools. If you go to the options wizard, we have actually built a new options 101 course section. So you have part 1 and part 2 here. Once we finish here today, we will post part 3. Once we finish a couple of weeks later on part 4, we'll have all of the available to you here under the options 101 course. So I also sent the link to those of you that missed the first course to you in the chat window. Miguel is saying, debit spreads look interesting. Are you already mentioning something about credit spreads? So Miguel, credit spreads are a little bit more advanced. They take a little bit more understanding of options. They have a little bit more risk. There's more assignment risk. So that is in the intermediate course. Debit spreads don't have those same dynamics. They're a little easier to understand. They're just a slightly improved version of a long call or a long put. That's why I introduced them. But I will actually have a whole nother section just on debit spreads as well. And I will have another one on credit spreads in the intermediate course, which is next after the beginner's course. There's a question here, vertical spread debit. How far of dollars do I need to look at? How far of dollars do I need to look at? I'm not sure what that means. Like $100 call option, buy to open, $100 call option, sell to open, or what? How far of dollar do I need to look at? So I'm not sure I understand that question. This is coming from anonymous. So if that's you, please, if you don't mind clarifying. Edward is saying, with the call vertical spread, what happens if the stock goes above the strike price of the short leg? Great question. So the question was, The question was, what happens if you go above the strike price? The reality is that nothing really happens. You're just capped in terms of how much money you can potentially make on the particular trade. So let's bring this up. You can also access your options wizard from your home screen. But the reality is that nothing happens. You're just capped in terms of how much money you can make. So if it goes above the strike price, you can sell the vertical spread. At that point, you would have reached your take profit levels anyway. You should close out your spread and take the profits. That's generally what happens if it exceeds your short strike on a debit spread. Julia is saying, Tony, in case of buyer of cover call option did not exercise option, I can sell stock. Can I still collect premium? Yeah, Julia, I mean, you don't have to worry about the buyer of the stock. You know, if you sell the stock, if you sell a cover call, you know, let's say you sell a cover call for $1. All you care about is what the value of that option changes to. If the option increases in value, then what you're losing is you're losing money on the call option, but you're gaining it on the underlying stock. If the stock goes lower, you're going to gain the money on the call option, but the gain that you have on the call option is limited to the $1 that you collect. So you really don't have to worry too much as far as, you know, what the buyer is doing. Again, early exercise is fairly rare. So as long as you have the cover call, you can sell the stock. You just have to buy back the call when you sell the stock. Do you also plan on covering bull put credit spreads? Gil, yes, I will. It's in the intermediate course, but if you are very urgent, if you want to get access to that information very quickly, go to the options wizard. Someone else also asked for the credit spread as well. So we do have this one on maximizing profits with debit and credit vertical spreads. You can use that link to help you better understand credit spreads. And this again is linked in the research and tools under options wizard. Why can't we roll forward short positions of a diagonal spread on first trade? Christian, you should be able to on a diagonal spread because you can trade forward like spreads. You should be able to roll forward your diagonal spread. I sold Neo cash secured put, but it's not filled. I closed today. I made $80. Thanks for teaching me. Raju, you're very welcome. Thank you for sharing. Bob is saying, started selling puts and then selling cover calls when the stocks were put to me. I'm ready to get out of my comfort zone and try verticals. Thanks for training us to make money. Love the options play platform. Bob, you're very welcome. And again, thank you so much for sharing. How buying power is affected by PCS, long calls and put spread verticals. So Carlos is asking, how is your buying power affected by these strategies? Great question. The answer is the buying power is simply reduced by the amount that you pay. That's part of what again, why I say debit spreads are an easy thing for beginners to wrap their heads around, because what you pay is what the buying power effect is on your portfolio. Just like if you buy, $1,000 worth of stock, your buying power is reduced by 1,000. If you buy a $500 call option, your buying power is going to be reduced by that $500. How do I decide to pick? So your question is, how do you pick your strike prices? Well, our platform already does it for you. You don't have to actually do it. That's the beauty of the options play platform. But if you were going to do it manually, what you want to do is you want to buy the 50 delta and sell roughly the 20 delta call or put against it. But again, like I said, the options play platform does the work for you. All you have to do is type in the symbol, select either I'm bullish or I'm bearish, and we pick the strategy, the expiration date, and the strike price for you. So it's all as easy as possible for you using the options play tool. First of all, thank you for the great tutorial. How can we use the options play during the life of an option strategy for trade management purposes? So right now, that's not what the options play tool is built for. You can use it to find the current premium of the spread that you're trading. So let's say you trade a spread, 2 weeks go by, you can use options play to price that spread so you can determine whether you've hit your take profit or stop loss level. That's the best way, in my opinion, to utilize this while you're in the life of your tool. Why one leg of position in a put credit spread affect my portfolio? The platform doesn't refresh this leg, the portfolio affected my buying power. So Carlos, credit spreads, it has a whole nother buying power. You have to take the full max risk of the vertical spread. That is the buying power effect of a credit spread. Debit spreads are different. Credit spreads, you are going to take out a lot more in margin than just what you're collecting in premium. So that's why the credit spreads are a more advanced strategy. Will an option be stopped out automatically of losing 100% before expiry? No, nothing will get stopped out automatically if you lose 100%. There's no such thing as automatic stops. I'm not sure where you might have heard that. Okay, so that is the end of the questions. With that, I just want to thank everyone for taking the time out here this afternoon. I hope this was useful and giving you a better understanding as to not only the strategies, what you can do with options, just the power of options, the flexibility of options, what you can do if you get a little creative, but more importantly, the tools that you have access to here at First Trade that helps you explore, analyze, and constantly evolve and learn and take strategies that we have with the markets and plug them into options play and test them out for your own portfolio. So with that, I want to thank everyone for taking the time out here this afternoon. I hope you guys have a great trading day. Please stay safe out there, and I'll see you guys here on Tuesday morning. Have a great night.